Well, the rate decision is in, and the line has been respected. We had a major rollover in the market this week, and Riz and I are going to tackle it. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our last market recap webinar ever for 2022. Welcome, everybody. So glad you could make it. We're rounding out the end of the year here. Next weekend is Christmas. Obviously, next Saturday is going to be the 24th. It's a holiday, so we're not going to have webinar then. And then, of course, the week after that will be New Year's Eve. I'm pretty sure you all have better things to do on New Year's Eve than come hang out with me and Riz. So this will be our last market recap of the year. And boy, it was a doozy this week. Obviously, here we were kind of sitting on the 100-day average, moving average rather, that is, and we had a nice little bounce up and looked like everything was going great into Tuesday. We ran into my line, which has held rock solid so far as our downtrend on the S&P 500. And then Wednesday came, and it was rate decision day. And boy, what an amount of whipsaw in the market we saw there. And then on Thursday and Friday, we just saw quite a bit more fade. Riz, this is kind of surprising based on, everything. It sounded like, the Fed was happy with things that were going on. It seemed as though the CPI numbers were coming down a bit, but man, the market reacted really negatively. What's going on with that?
Yeah, it was a bit of a delayed reaction. The market had essentially kind of caught up to the fact that, wait a second, the Fed is still calling for, a potential rate hike, and the odds went up, right? The next day, the odds actually went up to 75% chance that they do a hike. I think next meeting is January, if I'm not mistaken. So again, that shifted the landscape a bit, and this is not surprising. I've been about 95% cash now over the last few weeks. So I'm happy. Again, I can't speak for everyone, but just from me, how I'm specifically personally positioned, and I hope, I'm not expecting everyone, whether you're an elite or not, to be 95% cash, but primarily having a good cash position is great if possible. Doesn't mean you got to go out and just sell the great companies, but once again, having that cash position is what I've been asking people to generate and kind of focus on leading into the end of the year. And it's worked out so far. The market didn't exactly go right to the 3,800 level, but it pushed below the 3,900 level that I had pointed out to Elite, and that's exactly where it was. Just at the end of Thursday, and then Friday opened and went lower as well. So that's something to keep in mind. But market definitely finally decided to price in a little bit that, wait a second, this is not a complete pivot yet. The Fed hasn't gone out and just said on the record, okay, we're pausing rates, and then lowering them would be a complete pivot. But we haven't even gotten to the first part. They have to first pause rates, and I don't think we're there yet. I've said throughout the year that anytime you have, inflation, annualized rate above 5.5% annualized, no time in history has inflation ever gone back to the 2.2 to 3% range without benchmark interest rates being above inflation. So right now, to put some context, right now, overall inflation is roughly 7% in the U.S. Again, I'm talking U.S. numbers here, 7% annualized. After the recent hike of 50 basis point on Wednesday, benchmark interest rates are now between 4.25 to 4.5%. Okay, benchmark interest rates. These are now back to 2007 levels. So based on what I said, where interest rates have to be at or above inflation, that would still leave a bit of runway, right? And I'm not saying the Fed is going to go up to 7% because I don't think that's going to happen. I think inflation is going to come down a bit as we get into the new year, but it's a slow process. Inflation has turned out to be stickier, and I've used this word before, stickier, meaning it's stuck around. It's remained more resilient. And hasn't just completely turned off or gone down like a light switch per se. So I feel what's going to happen is the Fed is going to maybe, I don't buy the 75% odds of a rate hike, but maybe it's a 50-50 right now for a January or whatever the next meeting is for a small hike, maybe a 25 basis point hike. Okay. That would be the first 25 basis point hike in a really long time. So I feel that might happen. And there's a slim chance that maybe they just pause, right? No way are they cutting rates. No way are they cutting rates, and no way are they cutting rates anytime in the next, few months, I would say. I don't think it's going to be a rate cut in Q1. Okay. So what does that mean? That means this 4% to 4.5% range of benchmark interest rates is the norm. This is the new norm. So the last 15 years from 2008, okay, to 2021, that period of cheap money, excess, hot economy, easy borrowing, leveraging to the max, that's over. That's over. And for people like me, that time sucked because people like me, we don't over leverage. We don't, take on debt. We don't, go with the excess. We always leave a margin of safety. We always look at it from a very neutral standpoint. In we spend less. We're more financially, let's just say savvy. Whereas everyone else, they just get leverage to the max. They use everything they can and more. And now this economic situation hurts those people the most, right? And I'm not trying to make this like me being better, and I'm just giving you a clear cut example of how I perceive finances, right? I'm a lot more old school and traditional for those that know me. I like to keep things a lot more simpler. I don't like to have any debts. And I know people will say, Riz, but that's stupid. You could leverage your money and, you know, make more return than the cost of interest. And yeah, sure. But I like sleeping easy at night, knowing that, I don't owe anyone anything. So this kind of economic environment where it's now more expensive to borrow and it doesn't make much sense to borrow anymore. When you think about it, like could be getting, mortgages for 6.5%. You compare that to 1 year ago, it was half that, 3.5%. Right. So look at that difference. So now all of a sudden, within a span of a year, we've gone from, oh, hey, it only costs me 3.5% to borrow hundreds of thousands of dollars. To holy crap, it's costing me 6.5 to 7% nearly. That's a big difference when you do the number after, in total interest costs, not just 1 year, but let alone 5 years later. It's a huge, huge difference in numbers, right? Compounding, 101. So we're in a different, very, very different economic environment going forward. I would say that, we're back to getting some normal monetary policy. The last 15 years, the last 10 years especially, have been unprecedented, not the norm, and I think this is going to be very, very important as a big global long-term outlook, outlook for people to understand. If you can understand that the way things were just 5 years ago are not going to be the way things are the next 5 years. If you can understand that and go into 2023 and beyond in the back of your mind that, okay, no longer can I, live, so, bougie. I can't be so fancy. I can't just, get this loan and get that loan and finance this and finance that and buy 3 houses on mortgage instead of getting one, right? Those times are changed. Okay. So we'll see the impacts of that as we head into 2023 and beyond. Okay. So a little bit of a macro and a personal finance slant there for you guys. But when it comes to markets, I personally feel like 3,800 level for the next week is possible. But here's the question mark. We know historically, I think it's like a 75-80% chance of what's known as a Santa Claus rally. So this is an interesting phenomenon where in the last trading week or so of the year, we usually see about a 75 to 80% chance of markets rallying. Now, that doesn't mean that rally is going to continue into the new year or that's going to set the stage for the new year. In fact, as Chris just beautifully circled out, it can sometimes mean that rally completely reverses course. I'm not saying that's exactly going to play out the same way, but it's something to be cautious about. That's the only thing. I personally feel like we could see 3,800, but that Christmas rally type of thing is what's kind of giving me pause for concern. In fact, I mentioned to elite members I wanted to dabble. I wanted to get into a couple of names to this week, especially Friday yesterday, but I didn't. I just held off because I'm taking things a lot more cautiously. There's no point trying to jump the gun just yet.
That was some excellent advice there, to say the least. And yeah, it's definitely time to pay the piper. Easy money days are over, to say the least. That's a great way to put it. And yeah, well, it'd be interesting to see if we get the Santa rally this year or not. We'll definitely be keeping an eye on that. But let's look here. We've got a few new features for webinar we're going to unveil today. And first one, we've got some important, financial dates coming up. And, most of these, I would say, are not things that people are going to be too tight on. But Riz, is there anything here that we really need to be watching? I'm not seeing any big numbers coming up this week.
Yeah, these are the more, I would say, more important economic macro events. None of these are the top ones. Like we just had one, obviously, being the Fed decision. We had some employment numbers already come. We had inflation numbers already come in. So this week, although these are relatively important, they're not the end all be all. So just some importance here that you can see. Building permits are kind of a forward looking indicator into housing. So those remain pretty decent. In fact, we had a nice uptick in building permits and more houses being built ultimately. And remember, these are the monthly ones, so these are for November numbers. Okay, as you can see, it's very faint, but it says NOV beside, so that's for November. Durable goods, personal income. These are all gonna give us a little bit of an insight into consumer sentiment month over month. So that's month over month change. So we actually seen these things go up. So this is a little bit bullish from a consumer spending standpoint, but bearish when it comes to the Fed. Why? Because these numbers say that the consumer is relatively strong. The consumer is turning out, as it seems, to be pretty financially capable of spending more and has more maybe tucked away, or it has more purchasing power than initially thought. Hence why there's actually, a basis for the Fed to continue to raise rates, because the labor market, the consumer, the average earner is not actually, decreasing or spending less, right? They're spending more. That tells you the consumer is relatively strong. So this is something that we've added to our weekly webinars. I hope this kind of brings a little bit more context, gives you what's to come with the date along with the time of the release, right? So although it's a little bit light this week, obviously, as the months come, you'll see on a week by week basis the key important events coming for the week.
And obviously, these numbers are playing a huge role in the reaction of the market. It's why we want to make sure that you're aware of it, as opposed to me just scribbling the date here on the chart. I thought it might be a little bit more valuable for you to get a full view of what's coming up in the next week. Now, we've got a lot of changes on this next one. We have our market sector screen here, and we went ahead and made a ledger for you, or a legend rather, so that you know what all of these different ETFs stand for. Now, the first couple you're going to be pretty familiar with because we've been using them for years. XLU Utilities, XLF Financials, E Energy, K Tech, RE Real Estate, and then V Healthcare. Now we've got three new ones that we've put on, and Riz is going to give us a little rundown on these. So XLC is communications. That's a big one. He'll explain why. XLP is consumer staples, and then XLY is consumer discretionary. So Riz, why did we go ahead and add these three new ETFs onto the chart?
Yeah, thanks, Chris, for breaking that down. So XLC is the one we've added. This is, again, all these are individual sectors of the S&P 500. Okay, so they're not, some random ETF. They're important. They go with the theme, which is individual S&P 500 sectors. And there are a couple more, but I felt those ones aren't as important. There's industrials and materials. I don't think that I don't want to focus on those. And besides, the more we add, it becomes a little bit overkill. So even when I was adding these three, I was like, it gets getting a little bit more busy, but that's fine, right? This is, I think, a good sweet spot now, where communications. The reason communications is important, I'll tell you why. And we added that is because you would think communications, you know, being, AT&T, T-Mobile, so on and so forth, right? Those are communication stocks. But what's actually also a communication stock or fits into that sector is Google, Alphabet. That's actually changed over to communication stock sector, and that actually happened a year or two back. So that fits into a communication sector, not the tech sector. Even something like Netflix. Netflix fits into communications as well, which I found pretty odd, but hey, that's the way they've classified it. So that's something that we want to also keep an eye on. Consumer staples. This is an important one. This is all the stocks essentially that people will really buy brands. The first thing that comes to mind, think of it like, Johnson and Johnson. It's a consumer staples company. We got McDonald's. We got Walmart. They're consumer staples in a way. Why? Because it doesn't matter if it's a recession, if it's an economic, boom, if we're in an economic expansion, or even if it's a depression. It doesn't really matter. I think people will still go to McDonald's. People will still go to Walmart to get whatever they want, whether, it's a groceries. They want to go to a grocery store. They want to go to anywhere. These kinds of things will always be used, and they will always um, have some demand. Demand will decrease, purchasing will decrease with them, but these are known as also defensive stocks, right? I don't mean defense in the sense that, military type, but defensive stocks, right? So these are stocks that usually uh, do decent and hold up pretty well in times of recessions and decreasing economy, and of course, decreasing market. Consumer discretionary is now the stuff that people choose to buy with excess discretionary income, meaning money left over they have saved up or money they have to spend on other things besides, you know, staples like food and rent and groceries and all that. So, consumer discretionary could be some electronic companies, could be, things that you would go out and buy as maybe, you can afford it, you want to, right? So consumer discretionary is another important sector that we've added. So all in all, I think Chris, what is that? Like what three, five, six, seven, like maybe nine? I think total sectors there, and then adding the S&P 500 would be 10 SPY, right?
Yeah, absolutely. And, we wanted to give you a broader understanding of where the market's at, get a few more sectors in here while not overloading our chart completely, just to give you a more clear understanding of what's going on in the market. And, we can kind of see here, this week energy took a little bit of a dip, a nice rebound here, and then kind of closed the week down a bit. Everything else kind of rolled over with the market this week for the most part. But yeah, energy's still flying high at this point. But this gives you a good idea. You see here consumer staples here pretty close to the zero line. I mean, it's down 2% on the year, or almost 3%, but still a whole lot better than the S&P 500, which is down nearly 20%. So definitely outperforming the S&P 500 right along there with healthcare and utilities, like we've seen for most of the year so far.
Yeah, yeah, and that really drives home the point that, consumer staples are holding up, right? And then you compare and contrast that to something like XLY, which is consumer discretionary, could be, more hobby purchases, excess, purchases. That sector is definitely lower. And communications is interesting because I would reckon we have companies like Google and their Netflix and their both have dropped significantly. So that's dragged that sector down as well, right? And of course, there's some, communication companies like mobile carriers like AT&T, we have uh, Comcast and all those kind of not doing too ideal as well. So uh, again, gives you a more accurate, fair representation of the broader S&P 500 index now.
And that's what we want to do. We want to make sure that we're giving you a clear understanding of what's going on in the market, where everything is. And let's move to an old chart with a new look. We've got our light crude here in the light blue here. Looking like crude is taking a bit of a dip this week, though, hanging right around the 76 support and resistance area. And then we've got gold here on the right. We switched these from candlestick charts to just the line chart to give you an idea of the direction, because that's really what's important. It's not so important that on this day we had this candlestick pattern on gold or anything like that. Really, we want to understand where it's going, what it's looking like. And so we just wanted to simplify these charts down and make it a little bit easier to understand, to give you a better understanding of what it's doing and where it's going. So oil obviously looks like it's going down, and personally, I'm starting to see that being reflected at the pump, which is a nice change. I'm not going to lie. But I thought, if I recall, Riz, there was some talk about OPEC possibly upping production. Is that going to happen, or do you think that we're going to see oil continue this downtrend here?
Yeah, so I feel like right now, no concrete evidence to say that they will um, up production or decrease just yet. I doubt they're going to up production. If there's chance they might be actually decrease production, which is a little bit bullish for oil. But we have to keep in mind that as we head into and are now in the winter uh, season, as I've said for many months now, that this is not uncommon to know that usually we have less demand these months, right? As is obvious. So it's be interesting to see. I don't have a position on oil outright. But I am kind of wondering if maybe we can continue to see this go lower. This definitely looks bearish. I wouldn't be surprised if we see the 70 mark sooner rather than later. I think I said that last week as well, and it's looking like it. So let's see.
Something that's not looking too bearish right now is gold making a really big run here ever since about the beginning of November, really making a huge push up north. But we're back in the channel that we had been in for so long. I mean, if I zoom this out, we can see we have just been kind of stuck in this area for, it looks like well over almost 2 years, 2.5 years at this point. So really kind of not too much going on with gold, though a nice rally recently to bring us right back basically in the middle of the channel. So I know we don't have any positions on gold at this point. We're not recommending that you take any either. But Riz, what are your thoughts here with gold? Or, what's pushing this rally so high? And, do you think we can continue back up towards, this 1960 area?
Yeah, so I don't think we're gonna see 1900 area, especially not that kind of near high anytime soon. But this is definitely bullish, for gold. Why is it moving up? I'm kind of surprised, and everyone is kind of just considering, maybe we have some funds and institutions now getting back into gold with, some of the long-term economic and macro indicators kind of looking more bearish. So maybe many of these institutions are now buying into this asset class now compared to the last year where they were potentially dumping and rolling back out of those, right? So that's the only kind of, I would say, reasonable explanation for what's occurred and what's now occurring since November, right? Institutions now coming back in to gold as perhaps a little bit of a safe haven. It hasn't worked as well of a hedge the last few years, as we've mentioned on here. But who knows? I think maybe as we see the economy continue to slow down, as we see markets continue to be volatile, it's not unreasonable to think that we have some institutions probably biding their time with having capital in gold.
There you have it. Now we're going to unveil a brand new chart, and this is one that people were asking for. We talk about this sometimes. We talk about the bond yield curves and things like that. And so we have our bond yields here. We have two of them. I have a nice little legend here for you. So the 10-year Treasury bond yield is going to be the purple line, and then the blue line is the 2-year Treasury bond yield. So you'll see right now that we are what we refer to as inverted, meaning that the 2-year is having a higher yield than the 10-year. So Riz, I know this is a very significant economic indicator. What is the deal with bond yields?
Yeah. So as we see bond prices come down, yields go up. So this chart is just for yields. Yield is essentially the interest you earn on bonds. So these are Treasury, U.S. government Treasury bonds, which are 2-year term and 10-year term, respectively. These are effectively known as the risk-free rate of return. All right. In fact, these two are also used by pretty much all the banks, all U.S. banks, even global banks, to set lending rates from things like mortgage rates to car loans, line of credits, personal loans, business loans, so on and so forth. Now, that doesn't mean they're going to be 3.5% or, something like that, but they factor these into the model, right? So as a rule of thumb, if you see bond yields for these 2 and 10-year go up, like we've seen over the last year and up, right? Chris, if you zoom out there, you'll see that bond yields have been trending up from near zero, right? Because interest rates were slashed to near zero, and they've been trending up the last year and a bit, right? So again, what impacts bond yields? Interest rates, benchmark interest rates going up, right? What also impacts bond yields? The risk appetite for the investor. So this is very much a macro lesson here for you guys, where the risk appetite for investors goes down, bond yields go up. Okay, because money is now, effectively, people are thinking, well, it's better to have a more secure, safer, almost guaranteed 3.5 to 4% return compared to putting it in the market, which usually annualized has about an 8 to 10% return, but also has a lot more risk, right? So the risk appetite has decreased uh, significantly over the last year. And why? Because it makes more sense to have a safe, guaranteed rate of return of 3.5%. So it's now it's a complex topic, but it goes into risk premiums, so on and so forth. But ultimately, these are the two treasury bonds that the market looks at, not on a day-to-day basis, but overall basis, kind of seeing what is the interest rate environment going to be like? What's happening? The bond market is now, again, the treasury bond market specifically is now essentially, I would say, pricing in uh, potentially a decrease in rates in the next year. Okay, so that's something to keep in mind. It's not going to happen right away, but they are anticipating a decrease in the 2023 year. Now, how much we don't exactly know, but overall, we do know bond rates yields have been going up, and that provides investors, whether they're hedge funds, whether they're endowment funds, whether they're pension funds, an opportunity to cut back on the risk and get a 3 to 4%, safe return annualized. Okay, so this is very much up to interpretation. Again, it takes a lot of time, a lot of experience, a lot of know-how to interpret these numbers, and in fact, most people don't know. So hopefully, we can continue to provide a little bit more insights as we continue these webinars into the new year.
And then the next chart, which has got to be my favorite, the green stuff, the stuff we're all trying to get our hands on, that would be dollar bills, y'all. So this is the US dollar currency index. Now, this is not a currency pair. I mean, typically when you hear people talking about currency, you're talking about like the US dollar to the euro, or the the Chinese yuan, or the British pound, something like that. This is actually a composite of the US dollar compared to all of those and more. It's basically compared to all other currencies out there. And right now, we're seeing the dollar looking to be doing some weakening. Now, is that a good thing for us, Riz, or is that bad?
Yeah, I wouldn't call it a good or bad thing. For now, I think it's definitely better. Where the US dollar was, 2 months ago, was definitely elevated, and that is not ideal. A very strong US dollar compared to other global currencies isn't ideal for trade, isn't ideal for the manufacturing and industrial sector. Again, it impacts exports and imports. It also impacts, you know, uh, the Fed's balance sheet, all that kind of stuff. But that's a little bit more extensive. But overall, having the US dollar, um, you know, not erode its value, not completely get demolished compared to other countries is a good thing. But remember, it's like one of those things where too much of a good thing can be bad. So when you have a US dollar, running up too high, for example, I'll use the comparison between the US and Canadian dollar. So USD Canadian pair, was up until maybe a month ago very close to 1.4, right? So for every one US dollar, you could get one dollar and 40 cents Canadian. That's a big difference. In fact, maybe I think 10 years, maybe a little bit more than that, there was a time when the US dollar and Canadian dollar were on par. One Canadian dollar was worth one US dollar, right? So again, that wasn't the norm, but generally speaking, the US dollar is stronger than the Canadian dollar, but by nearly 40%, that's a bit too much, right? So the thing with these currency pairs, and in this case, the index, you don't want it to be too elevated. Chris, if you zoom out a bit further and we get into 2020, 2021, right, look at how it's trending. We've seen the US dollar continue to get stronger since 2021, right? So what we want it to be in a stable, it's always going to move in between a range, but we never want it to be so out there when it's really been out there from 2 months ago, right? So now it's kind of reverting a little bit back to this previous range. By no means back to where it was 2021, but still a little bit of a normalization, so to speak. And one of the reasons why we saw a very strong U.S. dollar the last, few months, especially, is because we continue to saw higher rates. Higher rates, usually end up being bullish for the U.S. dollar, and then you mix that in with weakening economies for other global economies. So we had, it's not a secret. We've seen, countries like uh, the UK, Great Britain. We've seen Germany. We've seen, a large part of Europe uh, go through a lot of economic uncertainty the last year. So that's depressed the pricing of their currency. And then you compare that to the US dollar, you can find that, it wasn't long ago where one US dollar got you one British pound. If you remember, a couple months ago with the UK fiasco, the pound got crushed like 30% in about a couple days, right? So by no means we're not currency traders or anything, but we definitely important to keep an eye. And one thing I will point out, uh, since today is the first time we added this indicator, is that usually when you see U.S. dollar get stronger, it's inverse for things like oil prices, commodities. It's usually inverse. So US dollar stronger, commodities go lower. Commodities going up, usually that ends up being weaker for the US dollar, right? Doesn't always play out one to one, but generally speaking, before COVID and last year, that's the theme that usually ran. That correlation is still present, but a little bit less post COVID.
Excellent insights, and this will be interesting to watch here going into next year how the dollar behaves compared to all these other currencies. And speaking of currencies, one chart that hasn't changed at all is our cryptocurrency chart. And yeah, there's really not much going on here. Crypto getting absolutely crushed. Bitcoin has dipped down below the 18,000 mark, and it does not seem to be able to get out of there at any time soon. Really just languishing down here, and we had a little bit of a rally coming into this week. Hit 18,000, rejected off of that pretty hard, if you ask me, and we're just really sitting here right around 16,700 right now. So, not much going on with crypto. Riz, do you see any hope for crypto, or you think it's we're kind of beating a dead horse at this point?
Yeah, it's funny you mentioned that, with all the stuff that's happened with FTX. In fact, I don't know if we mentioned it last week. I don't know when it happened, losing track of time, but uh, former CEO of FTX Exchange, Sam Bankman-Fried, is now in the, has been arrested, is in jail in the Bahamas, and there's currently musings that he may be extradited to the U.S. And be charged criminally in the U.S., which is good, and from a justice standpoint. Um, but another development that I'm hearing now is that the largest crypto exchange currently, uh, which has been the largest, is Binance. Binance um, now is pretty much the end all be all for liquidity when it comes to crypto, because it's the largest exchange, and it's only gotten bigger because of the downfall of the second largest exchange, which was ding 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 FTX. So that puts a lot of consolidated power in the hands of Binance. Now, without getting too technical, ultimately there are some rumors, musings of some liquidity concerns around Binance and how accurate some of their reporting and audits really are. And without trying to you know blow smoke and raise the alarm for nothing, I will point to the fact that there were some, let's just say, uneasiness prior to this FTX fiasco. There were some signs. No one was really paying attention, and that's why everyone was caught off guard. But there were a few musings, a few signs there were like, wait, this doesn't seem ideal. Could there be a run on the exchange? Could this exchange really be solvent? And obviously, we know how that played out. But that's something to keep in mind. And as a result, to be very transparent as usual, I don't have a position in crypto. I don't think I'm going long just yet. Um, but again, I haven't made a decision just yet. But just to be transparent, I might, maybe consider a speculative short on crypto, Bitcoin specifically. Okay. If I do, I'll let elite members and maybe even everyone else know when I do. But just something to kind of share my thoughts as we head into the next week.
And of course, crypto is going to be trading regardless of whether it's Christmas or not, whereas the market's not so much. As people now is the time for everybody here who is on live to go ahead and post your questions that you have for Riz here as we come into the end of the year. But I'll post a question to kind of get things started. I know you said you were thinking about possibly getting into some positions here. Is there anything that you're watching this week?
Yeah,
Just for people to have on their radar.
great. Yeah, great. So for me, two stocks. I mentioned them earlier in elite, but I mentioned them now for people on, and especially those who are watching on YouTube. Two stocks that I really like right now are Apple. Uh, Right. No brainer. Amazing company now nearing the year's lows once again with the rollover in the market. Again, getting closer to that 130 area support zone, right? Anything below 132 is honestly a good entry point personally. But I remained patient, remained disciplined, didn't want to get into early. So let's see how the week goes. Might dabble in with a starter position this week. Next is Amazon. I know, Chris, you're making your lines there, but next is Amazon. This is another beaten down one. This one doesn't have too much relative strength as the markets continue to move up. This one's just languishing as well, very much near its year lows as well. So this is something I'm keeping an eye on. I don't want to bottom fish on this one. I don't want to just catch a knife on this one if this goes lower. But the fact that it's holding this 86, 87 support zone is good. So still waiting on this as well. These are the two key ones that I'm considering, but I'm not in a rush literally as we're in the last couple weeks of the trading year, and really will come down to if we see that Christmas Santa Claus rally or not.
I think that brings up a good point is to really not necessarily force it, especially when we have things going on. Traditionally around Christmas time, typically volume in the market kind of starts to die out, at least in my experience. It usually is kind of quiet. We get that little Santa rally to give everybody their presents before the end of the New Year's, and then well, sometimes we give it all back if you're not nimble and ready to go ahead and sell if that rally happens. But I think it's really important, what you were talking about is like just being patient right now. I understand it's very tricky and you feel like, oh, we should be getting into positions and things like that. But sometimes the best position is not to be in a position. It's to be in cash, like you were talking about, building up those cash reserves so that when we do get to that point where like, okay, the needles are pointing in the right direction, let's go for it. And then when you see that time, you have your cash ready to go and to deploy that to help you really start to build up some profits and some solid gains. And so I would just say be very careful this week. Obviously, the market has been in a downtrend all year. We very well respected that downtrend. Every time we try to make a rally up towards it, we reject. And so I'm not saying that this, will continue. Eventually, we will come out of it, but it's not right now, at least based on what Powell was talking about in his speech after the rate hike. It seems as though they're a little bit hawkish right now.
Yeah, very well said.
Definitely. Well, I guess we left everyone in awe because I'm not seeing any questions from our people who are here on the live stream. So, Riz, with this being the last webinar of the year, Why don't you leave us with some Christmas advice for everybody going into 2023?
Yeah, thanks, Chris. So I'll speak personally. Again, I can't tell people what to do. It's their life, it's their choice. I'm a bit different. But for me, you know, take it easy. It's important to recharge, rejuvenate, take a break. That's, one of the reasons why we're not running those webinars is, as much as Chris and I love talking markets and being on these webinars, it's important to kind of spend time with family, friends, loved ones, even yourself, whatever your case is. Take a breather, enjoy as much as you can this sort of holiday time, whether you celebrate Christmas or not, whatever, it's up to you. But, you know, be a little bit more mindful as we head into the new year. Take stock of what you've accomplished. It's important to, what I would do is when I'm going to be going through and doing is seeing, have I accomplished my personal goals? How close did I get if I didn't accomplish them? And if I did accomplish them, did I exceed them? I'm very meticulous in that sense. I'll even be sharing on social media. Um, some of the key points to go into, more philosophical, more personal um, thought process and frameworks as we head into the 2023 year. But that will be in a separate social media post. But uh, I will say, in this time of the year, it can be a bit costly. It's no doubt going to be more costly than the last couple of years, with inflation and with everything going on. And not to mention, it's a bit more challenging economically with people feeling a little bit of the squeeze, the pinch, because it's costing more, the day to day basis. But not only that, but you know, maybe their credit card interest rates are higher. Maybe the mortgage is higher. Maybe the rent is higher. The grocery bills are higher for sure. The restaurant bills are higher for sure. So I would say do your best to be a little bit more cautious and mindful of what you're spending on, how much you're spending. Uh, w- Growing your wealth, and as important as participating in the markets is to grow your wealth, the first step is actually to be, cash positive, meaning you have money that you can invest. You have money that after some of your bills, uh, is able to be utilized in a more productive manner. And how do you do that? By keeping costs as low as possible and keeping your income as high as possible, which is one of the big reasons why I've always said don't solely depend on the market. Contrary to what all these gurus and frauds and idiots online say, you don't sit there and day trade, or you're going to hit the beach and hit your Lambo. Now, I think people are waking up to that, especially this year after the COVID, boom. But it's no brainer that you need to have a stable source of income. You need to have something else, and the market is a fantastic, fantastic way to supercharge your wealth after the fact. When you have some income coming in, when you have the right guidance, when you have the right community, the right people around you, it's a fantastic way to grow wealth. I know it's done that for me. I know it's done that for many people I know personally. I know it's done that for people in the elite community or students and all across social media that we interact with. So I'm very happy with that. Be safe, have fun. Uh, Really, I will say, take stock of where you've been and where you want to go, because um, yeah, it's only changing of the calendar year. Ultimately, nothing really changes until we do.
Sage advice there that everyone should probably rewind and listen to again until you understand everything that Riz just dropped on you there, because there was a lot of good nuggets in there. So I would recommend you rewatch that section. Again, yes, thank you so much. Everybody have an amazing Christmas, a happy new year. We will be back first Saturday of the year. We're going to be on here and we're going to be taking a look at what's been happening since Christmas. Of course, for all of our elite members, of course, we're still going to be an elite. And you can always ask us questions there. Well, go ahead. If you're watching this on YouTube, leave a comment. Let us know what you're looking to accomplish in 2023 as far as the markets or personal goals. It'd be great to see what you all are trying to accomplish this coming year. So I want to thank everybody for all of your continued support, whether it be on YouTube or if you're an elite member. We really appreciate each and every one of you, and we wish you an absolutely amazing holiday season, wonderful new year, and we will see you in the markets on Monday and in 2023.